Happy new month of October, and more importantly, happy Independence Day to our dear country, Nigeria. You see that I'm appearing like this for today's episode. It is my way of identifying with the spirit of independence and wishing Nigeria, our dear country, greater heights ahead. So on today's episode, and indeed for a significant part of this month, we're going to be looking at value-added tax. Remember that we spent a bit of time on withholding tax based on some of the clarifications I'd received in the past, particularly in the month of September. So for this episode, let us break value-added tax down. So when you hear of VAT, what comes to your mind? I've had instances where people have said, don't worry, I won't deduct withholding tax, you won't charge me VAT. As though they are complementary. They aren't quite complementary. In the time when the rate used to both be 5% for the generality of the transactions for withholding tax, for instance, and VAT too used to be 5%, it used to be very confusing for a lot of business owners who had wanted to do what the law required. But we are here now, and we want to speak to what we need to know in time. The first thing you need to understand about VAT is the concept of output VAT. When you talk about output VAT, we are talking about the VAT that you are charging to your customers. It's not hard. The VAT that you are charging on your invoice to your customers. That VAT, the rate is specified by law. The type of transaction that you can also charge the VAT on, the type of transactions, the types are also specified by law. But the rate is flat for VAT. Unlike withholding tax, where the rate differs based on the transaction type, VAT has a flat rate of 7.5%. During the just concluded legislative proceedings, we saw that there were attempts to increase the rates. But for the generality of the citizens and considerations here and there, we know the story. The rate was subsisted to 7.5%. So when we talk about output VAT, we are talking about applying that 7.5% on the value of the item you have purchased to the extent that that item or those items are vatable. So I give you a case in point. If I bought a good that is 100 naira and that good is vatable, as a business owner, what is required of me is I charge VAT at 7.5% on my invoice, and I collect, barring any deduction of withholding tax, 107.5 naira from the customer. Now, that is as simple as it can get when you talk about output VAT. On the converse side, you also have input VAT. When you are producing what you are going to be selling to the customer, and you had to pay VAT on other items, raw material that you have used to produce, that VAT that you pay at those points, those are the things that we call input VAT. So remember, output VAT is the VAT that you charge as a business owner on what you are selling to your customer. Input VAT, however, is the VAT that you were charged in at the point where you were procuring all of the raw materials or whatever you had used up to be able to produce, right, the good that you've sold, on which you have now charged output VAT. Those are the two broad concepts that you need to first take in as a business owner when it comes to VAT compliance. The promise on this channel is significant issues that impact your business will be broken down. So we won't rush it. We are going to pace ourselves and take it one at a time. And we are going to be drawing the curtain of today's episode here. Remember the two concepts we laid: output VAT and input VAT. Oladejo Adeyemi remains my name, and this remains Insight with Oladejo Adeyemi. Keep sharing, keep following so that you don't miss any notification, and keep adhering to the things that you learn on this channel. Till I come your way again, see you next time.